Coming up on Market to Market. Another year passes by, but not before rural America endures the perils of politics and the pitfalls of record production. We'll reflect on 2013 and examine the market outlook for 2014 with Jamie Kowalki. Next.
This is the Friday, December 27 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. In what has become a holiday tradition, the wind industry scurried in December to launch new projects before a subsidy expires on New Year's Eve. The federal tax credit of 2.3 cents per kilowatt hour generated applies to wind projects during their first decade of production. And that incentive has attracted major investors, including Warren Buffett. The Oracle of Omaha increased Berkshire Hathaway's stake in wind power this month by committing to a billion-dollar project in Iowa. Wind already accounts for nearly 25% of Iowa's energy portfolio, but that figure is expected to rise dramatically when 450 new turbines are completed by 2015. Rapid growth in domestic energy production was one of many developments this year with significant ramifications for rural America. So too were Mother Nature and gridlock in Washington. Paul Yeager reflected on some of the biggest stories in 2013 and filed this report.
2013 began in similar fashion as the year it followed, as lawmakers dealt with the severe case of electile dysfunction in Washington. More than 500 days after a budgetary time bomb began ticking, congressional leaders diffused the dreaded fiscal cliff at the 11th hour of the previous session. In last-minute negotiations between Senate Minority Leader Mitch McConnell and Vice President Joe Biden, a combination of permanent middle-class tax cuts and fresh tax incentives on wealthy Americans sealed the deal. Other legislative wrangling had a major impact in rural America. After months of tedious work on the 2012 Farm Bill, House leaders acquiesced to a simple one-year extension of existing law. The extension, however, was a blow to farmers hoping for direction in U.S. agricultural policy. The Farm Bill, or lack thereof, proved to be a never-ending storyline for the 113th Congress, which endured one self-inflicted wound after another. The only thing moving slower than Congress last winter may have been the Mississippi River. Barge traffic slowed to a trickle 150 miles south of St. Louis, forcing the Army Corps of Engineers to remove rock pinnacles from the beleaguered waterway near Thebes, Illinois.
I know that this is a matter of great interest and concern for all of us in the region.
The Mississippi, of course, is America's primary waterway for grain exports. But a more controversial conduit also was in the news this year. The proposed Keystone XL pipeline would funnel crude oil thousands of miles from Canada and North Dakota to Gulf Coast refineries. Proponents say the project would enhance U.S. energy security and create more than 50,000 jobs. But critics claim the project is an environmental nightmare. While the full impact of the controversial proposal remains to be seen, the Obama administration remained firmly on the fence. In a review last spring, the State Department expressed no major objections, but stopped short of fully approving the controversial project. Despite the neutral response, those opposed to the project continued to express their concern.
830,000 barrels per day at 2% is 16,600 barrels per day leaking undetected in my water, on my property.
Further west, the state of Colorado served as a microcosm of the rest of the country in the weather department. Initially, there was concern over dry conditions.
There's snow in the mountains, but yet we're seeing flame at the same time, and it's just unheard of out here to see this time of year. And I just hope this isn't the new norm, what we're going to be seeing every summer and every spring out here. It's kind of frightening.
But change was in the wind, and after sequential years of drought, forecasters called for a shift in weather patterns in the Rockies and other parts of America.
The overall picture is certainly better than we were this time last year, especially for the Midwest. We still have a lot of concerns from California to the Central and Southern Plains, however.
Things appear to be changing in Washington, too. After months of partisan bickering, lawmakers agreed to an $85 billion package of spending cuts known as the sequester. And, as fate would have it, the cutbacks took effect just as the economy exhibited its most sustained improvement since the recession ended in 2009. Half of the $85 billion in reduced spending would come directly from the defense budget. The remaining amount was slated to come from discretionary programs like education, law enforcement, and through furloughs of federal employees.
Americans know that Washington has a spending problem. It's hurting families, it's hurting small businesses, and it must be addressed.
For the most part, the sequester had a muted effect on rural America, largely because major cuts in agricultural spending appeared to be looming on the horizon in the Farm Bill. And with little direction from Washington, America's farmers set out to plant the largest number of acres to corn since 1936. But soil temperatures struggled to get much above the freezing point in the heart of the Corn Belt. And the National Oceanic and Atmospheric Administration reported that April was the second coldest month since 1895. Timely rains delivered crucial moisture to most of the region, but with temperatures hovering more than 10 degrees below average, Mother Nature delayed planting for weeks, and the Mississippi River escaped its banks in some areas. As the calendar advanced to May, Old Man Winter returned for an encore. Planters that in many years would have been halfway through their annual chore were idled under a blanket of snow that set records in several Midwestern states. Within weeks, though, triple-digit temperatures returned to the Grain Belt, while tornadoes roared across the southern plains. An EF5 twister demolished Moore, Oklahoma, marking the town's fourth devastating touchdown since 1999. EF4 tornadoes ravaged the area in 2003 and 2010, while another EF5 racked up over $1 billion worth of damage nearly 15 years earlier. Back in Colorado, tinder-dry brush fueled the largest outbreak of wildfires in the Rocky Mountain State's history. Fires in the Black Forest area alone charred 25 square miles. And memories of the Waldo Canyon blaze of 2012 prompted residents to take evacuation orders seriously.
I think everybody's afraid after the fires last year. So I think people are getting out a little faster this year.
Hit the top of the tree!
By August, wildfires also were burning near Yosemite National Park and the Sierra Nevada mountain range. The Rim Fire blackened an area larger than Chicago, while other blazes ravaged portions of California and Arizona as late as December. And only months after being scorched by the wildfires, Colorado had a new meteorological malady, torrential rain. More than 6 inches fell in Boulder County over a 12-hour period as flash floods wiped out roads and damaged farms.
Oh gosh, 5 times more water than I've ever seen here.
Just weeks later, a rare autumn blizzard paralyzed parts of the High Plains. As much as 4 feet of snow fell in parts of South Dakota, leaving thousands without power and killing thousands of cattle.
A lot of guys losing everything, cows, calves, you name it.
Little federal aid was available to South Dakota ranchers because Washington was still wrestling with the 5-year authorization of numerous federal programs better known as the Farm Bill.
On this vote, the yeas are 64, the nays are 35. The 60-vote threshold having been achieved, the bill is passed.
The Senate approved its version of the bill earlier in May, eliminating direct payments to farmers and cutting $4 billion from the program formerly known as food stamps.
The yeas are 195, the nays are 234. The bill is not passed.
But the House of Representatives had different ideas, and lawmakers rejected an amendment-riddled version in June.
The yeas are 216, the nays are 208. The bill is passed.
A month later, the 2 new bills passed the House, one for commodities and a separate measure for entitlements. House reductions in spending on the Supplemental Nutrition Assistance Program, or SNAP, amounted to $40 billion, 10 times the cuts approved by the Senate.
There are 16 million men and women whose jobs rely on the strength of agriculture.
A bipartisan conference committee convened in October, hoping to make concessions between the two versions of the Farm Bill, but compromise has proven to be elusive.
Do you like green eggs and ham?
The true cost of political gridlock, however, was evident earlier in October when lawmakers played a high-stakes game of brinkmanship that nearly forced the U.S. to default on its sovereign debt. The problem began when House Republicans tried to use fiscal deadlines to derail the Obama administration's 3-year-old health care law. Hundreds of national parks and other federally operated agencies and facilities were shuttered. Some government publications, including key USDA reports that can move markets, were delayed and even canceled during the 16-day shutdown. But work continued in America's booming oil fields. In fact, the U.S. produced more crude in October than it imported for the first time in nearly 2 decades, and the trend is expected to continue. The Energy Department says U.S. crude oil could rise by 800,000 barrels per day through 2016, reaching 9.5 million barrels per day, just 1% below the all-time high set in 1970. The government expects gasoline prices to fall over the same period to just over $3 per gallon. The boom in domestic oil production, however, is not without opposition. Critics say advanced drilling techniques like hydraulic fracturing or fracking pose significant threats to the environment. Opponents also voiced their dismay with some forms of renewable energy in 2013. So much so that the Obama administration proposed reducing the Renewable Fuel Standard, or RFS, to 13.1 billion gallons. Since the biggest cuts are targeted for ethanol, some analysts expected corn prices to take a major hit. Prices were already down nearly 50% from record highs recorded in 2012 during the worst drought in 50 years. But corn futures prices remained above $4 per bushel despite proposed reductions in the RFS and the harvest of this year that's expected to be a record corn crop in the neighborhood of 14 billion bushels.
Don't mess with the RFS.
Nevertheless, plans to roll back the RFS drew impassioned responses from supporters of the biofuel industry. And in early December, virtually every player in the debate pleaded its case to the EPA.
API has encouraged that for the first time, EPA has acknowledged that the blend wall is a dangerous reality that must be addressed to avoid negative impacts on America's fuel supply and to prevent harm to American consumers.
The RFS was designed to drive investment in new technologies, to drive innovation, to drive new market opportunities. It was not designed to be convenient for the oil companies.
With the year rapidly drawing to a close, lawmakers scurried to wrap up business in Washington last week before heading home for the holidays. But a lengthy to-do list awaits their return in January. The unfinished business includes a languishing farm bill, tax and immigration reforms, and raising the debt ceiling before Uncle Sam maxes out his credit card again in February. With half of the session already in the books, the 113th Congress is on pace to be the least productive in history. And with a recent Gallup poll revealing an approval rating of just 9%, it's also the least popular. So it seems likely that Washington's case of electile dysfunction will continue in 2014. For Market to Market, I'm Paul Yeager.
Next, the Market to Market Report.
The downward trend in grain prices continued this week as wheat futures contracts flirted with $6. In light trading during a holiday-shortened week, March wheat lost a nickel, while the nearby corn contract moved 6 cents lower. Soybeans gave up all of last week's gains and then some as the March contract settled with a loss of 17 cents. Nearby meal followed suit, giving up $6.40 per ton. In the softs, cotton rallied this week as the March contract advanced by 97 cents per hundredweight. In the dairy market, January Class 3 milk lost 17 cents, while the deferred contract moved 23 cents lower. Over in livestock, February cattle traded at an all-time high Friday before settling with a weekly gain of just over $1. March feeders advanced by 88 cents, but the February lean hog contract posted a weekly loss of 60 cents. In the financials, the euro gained half a basis point against the greenback. Crude oil advanced by exactly $1 per barrel. COMEX gold gained $10 per ounce, and the Goldman Sachs Commodity Index advanced by more than 3 points to settle at 640 even. Here now to lend us his insight on these and other trends is one of our regular market analysts, Jamie Kowalki. Jamie, welcome back.
Thank you, Mike.
It's been an interesting day on Wall Street as we've seen a number of stocks hitting year highs and record highs. Talk to us about what's going on in the equity market as we end 2013.
Yeah, we're finishing on obviously a big-time bullish rally through this whole entire year. There's been nowhere else to go with any cash. And so it's all been piled into the stock market since the tapering occurred, up 6 days in a row, and looks to continue into next year. But I go back to there's just nowhere else to go with cash, and the money keeps pouring in.
So as long as the stock market is the compelling investment of choice, that's just going to keep it afloat.
Yeah, as long as interest rates stay low, CDs return nothing, checking accounts return nothing, commodities are very erratic, and investors like the stock market to diversify a little bit more.
All right. Now, as we take a look over at the commodities, the wheat market has been a tough thing to cheerlead about for the past couple weeks. If you're a seller, this week we saw another 4.5 cent slide. Where is this wheat market headed?
Yeah, selling did slow down finally, but it has been a complete bloodbath. 75-cent sell-off, roughly 675, 680 down to just shy of 601 this week. Rolled supplies have been the major factor. They've kind of dampened our exports at times. But we did see a good number finally this week in the export sheet. It didn't spur much short covering today, but like you're saying, it was a holiday-type trade, not much going on. The market is oversold, obviously, right now. I'm not adding additional shorts. I'm looking for a correction, like a 50% retracement up around 635 to maybe sell into then. But it's too overdone right now for me to sell into, and hoping the $6 mark holds, and we'll see some short covering coming into the new year.
See if Monday's trade with this export news behind us can maybe get that
some shorts out.
To take place. Mm-hmm. All right, now as we look to the upside, 630 was the number you were talking?
30-35 area, yeah. Right about roughly a 50% retracement.
Now, for producers planning for harvest, I mean, is this a good time to be making sales? Should you hold off? How is 14?
I would hold off right now. If you haven't done any selling, I would not chase the market right now. It's too overdone for me, and would wait for some type of correction. I think we will see some short covering. The big end of the year crop report is January 10th, 2 weeks from today. So I think we will see the funds, lighten up a little bit coming into that report. Also, we've seen the U.S. dollar weaken up too. If we can get the dollar back below 80, I think that would even, put some support underneath the export number and hopefully, spur some short covering.
All right, and again, get those export customers purchasing again. Now, that's a story that has been talked about a lot in corn, particularly as China has been a buyer of U.S. corn, and lately they've been turning away loads due to GMO contamination, as they call it. Talk to us a little bit about how that's affecting the market sentiment.
It's had some long liquidation in the market, but we still haven't broke out of the trading range that we've been in. Top side, right at the 50-day moving average, right around 438 for the March. Bottom side at 420. I think we continue to swing that range until the January crop report. We are going to see some fund rebalancing occur coming into the new year. Rumors are right now about 80,000 contracts will be bought. I don't think that's a big market mover, but it is something to watch out for. But here, like wheat today, corn had a huge export number. Didn't do much to the trade today, but it continues to provide support on breaks. I still think the 420 mark holds right now. The $4 mark holds longer term, as long as exports stay where they're at right now.
Now, as we take a look at new crop, we've got a lot of guys as we enter the new year beginning to take a look at their margins. How does the selling situation look for new crop corn?
It doesn't look very good at all. A lot of red ink across the northern plains, big cash rents. University of Illinois put a report out on Friday, anywhere from a $30 to $50 per acre loss compared to $60 to $80, $100 acre gain the last couple of years that we've seen. The numbers I like are 468 and 472. Those are some good key technical resistance numbers to sell into, but those aren't numbers that work for most people. But that's where I'd be a seller at right now.
Wait until we see a rally touch one of those points and then maybe, if need to, make some sales.
Right, start to nickel and dime with some futures contracts, and then hopefully catch a weather rally spring to lock more in.
You bet. Now talk to us about soybeans. That's been a compelling story all fall and into the winter, and we lost about 17 cents this week.
Yeah, that was the big mover this week. Despite the holiday type trade, 20-cent ranges were pretty much the norm again. The big news here was DDGs getting rejected from China. They went from corn over into DDGs. Saw a big sell-off in the meal that spilled over into the beans, and it spurred some long liquidation there. I think beans are still in a sell mode right now, selling rallies for me. There is no major threatening weather down in South America. There are tips of southern Brazil that are dry, but the 10-day forecast, it looks a little bit bearish to me that came out today. So I'm trying to sell rallies out in here and looking for that to turn on lower here through January.
And a rally, you're going to be looking at that 1320, 1330 mark?
I like the 30s, 35 area to sell into.
Okay. Now as we take a look at new crop 14, how are things looking there?
I think a guy has to be in the sell mode there as well. Numbers do look a tad bit better for some guys to sell the new crop beans. I think $11 beans, futures minus the basis, do work for some people, and I like selling there. 70s up in the 80s if somehow I get a pop up in the market. But it's all pretty much South American weather right now. Exports were good here again this week. But I think get your resistance numbers and be in the sell mode until South America turns a little more drastic weather-wise.
All right. Things to keep in mind as we roll into 2014. As we take a look over on the livestock side, looking at the cattle market, we did have an interesting day in fat cattle. We touched an all-time high for the most active contract, touched 135 and change today. Where is this fat cattle market headed?
Longer term, I'm still bullish out into early springtime. I think we could push high 130s cash. I was on here saying 139 once and still stick by that. But yeah, what a wild ride today. I mean, cash was all over the place, $2 higher, then 20 minutes later, $3 higher, then reports of $4 down in Texas higher, just all over the place, and had a good rally going. But I think you buy the bricks, 133.10 in the Feb, 166, 10, 20 area for the feeders, and look for a retest of the old highs yet and new highs to hold.
Now, as we watch this cattle market intensify, we're counting on tight supplies, which we know we have. We're counting on the U.S. economy to continue to strengthen. Where does the export situation fit into that fat cattle market?
It's still a very big chunk of the pie, and we're going to be back in Asia again. So that should help out here, get that ball back rolling. And like you're saying, the tight supply is underpinning everything.
Now, where in Asia, what has changed in the Asia situation?
We're back negotiating with Japan again, and hopefully get that export door open.
All right. Yeah. Now, as we take a look at the feeder cattle market, we did see a little bit of a move up this week. How does the market look for feeder cattle?
Looks great. I'm still bullish here too as well, and I don't see corn doing much, so I think the feeders will stay supported off of that, and look for a retest of the old highs, even new highs this spring, by spring.
So you're looking for the 169, 170 as we get into spring?
Yeah, right now the August feeders are right around 169, 170 area. I'm targeting 174 area out into there, but if that would occur, I'd be a pretty aggressive hedger.
Now, as we watch, since we have seen a bit of a rally this week, chances are we might see some technical selling here. At what levels should we be looking at to make some purchases?
I'd like the 166.10 area for the March is where I'd be a buyer at, on a $1.50 area setback somewhere in there to get long. Hopefully we can get some profit taking next week to finish the year out, see the market back up a little bit, and try to reload then.
All right. Now, as we take a look at the hog market, saw a bit of a sell-off today, but we did have the USDA Hogs and Pigs report. Talk to us a little bit about what we saw in that report.
Yeah, it wasn't a big, huge surprise to me. Pretty much a 1% drop across the board. Early calls are 50 higher. I'm not sure if that can hold or not. There hasn't been a whole lot of bullish news here lately for the hog market. Ample supplies here for the nearby. Bellies have really fell out of bed, and just seeing the market trend on lower. Seasonals are turning into a buy, so we will see some buying coming off of that. But the market is a little bit oversold too on the daily charts. I'm actually looking to pretty much exit the last few shorts on another break lower. If we're going to sell off next week, start to back out of shorts and sell some puts. I like selling the Feb 83 strike puts on a setback next week.
Okay. Now, you said the report we were about 1% lower across the board. Is that really what the trade was anticipating as we watch this hog herd fluctuate with folks putting on more weight, growing the sow herd, and then also dealing with the PED?
Right, and the support will come from the deferreds, like you're saying, with the PED virus. I think the trade will still be buy the Junes, buy the Julys, sell the April or Feb against it eventually. That'll still be a pretty heavy spread to watch out for next year.
All right, so we're looking at buying in the 83s, selling off around...
I like just selling those puts, 83 strike Febs around $1.20, and just looking for the Feb futures to hang around 85, 87 area.
Okay. Now let's take a look over at the crude market. A lot of folks across the country saw gasoline prices spike here heading into Christmas, and again here in the past day or so. As we talk RBOB and crude, what does the future look like?
It's bullish here right now. We've $100 crude again on Friday at times, but the strength is really not in the crude market. It's spillover mostly from RBOB. The Atlanta gas market has been on fire. Very, very tight supplies out on the East Coast, and that buying has spilled over into the crude market as well. I think crude can go 101, 101.5. That's your next major area of resistance once we close above 100. And I think short term, there's still some more upside, especially with the dollar being weak.
All right, so for consumers, looks like we might have high gas prices for a while.
Yeah, here short term, I don't see them to back off at all.
All right. Well, thank you so much for being with us tonight, Jamie.
Thank you.
That wraps up this edition of Market to Market. But Jamie and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. And be sure to join us next week when we'll examine the impact of drones on precision agriculture. Until then, thanks for watching. I'm Mike Pearson, wishing you a happy and healthy New Year.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.